A warm welcome to all, and thank you for joining us for yet another insightful webinar from ICICI Bank. I hope you and your loved ones are staying safe. I am Anis Ali, and I will be your host today. Today, we shall be talking about a topic that guides our future investment decisions. And for that, we will try to decode the union budget and understand the impact that it creates in our day-to-day life. To share his thoughts and insights on this complex subject, it is our pleasure to have with us today Mr. Pankaj Pandey, who heads the retail research at ICICI Direct and has been with ICICI Securities for the past 20 years. Under his leadership, the ICICI Direct research team tracks over 100 companies across 16 sectors in the large, mid-cap, small-cap, and micro-cap universe. He also leads the technical and derivatives desk. So, with this brief introduction, I will now request Mr. Pankaj to take over. Over to you, sir.
Thank you, Anish. Warm welcome to all to this session. Last 7 days have been very eventful for the Indian economy. One, we had Union Budget 2026-27. And I think the much awaited India-US trade deal also got announced. And both of which will have pretty good implications for the markets going forward. Coming first to the Union Budget, so Union Budget 2026-27 is following a very standard template of capital expenditure-led growth. And clearly what we are seeing over the past few years is that the government share of capital expenditure has been sort of going up. And expenditure has been happening in traditional sectors like, say, road, railways, a bit of defense. But now this time, what is sort of standing out is that now the budget is providing support to sectors or emerging sectors or themes like data centers, healthcare, rare earth minerals. And while this is being done, the fiscal prudence glide path is pretty much followed. On the taxation side, we are having a pretty stable tax regime, both on the direct tax side and indirect tax side. So I think sum total, what the budget is sort of laying is the foundation for structural growth rate for the Indian economy in years to come. And I think our sense is that Indian economy will continue to be one of the highest growing economies globally going forward. Coming to the specific announcements on the direct taxes front, overall, the expectation is that the budget is penciling in 11.4% kind of a growth. On the indirect tax front, the growth is expected to be lower, largely because of the GST impact. If you all sort of recall, in the month of September, the government had cut GST rates on a number of categories. As a result of that, there is a degrowth expected in GST revenues. Overall, the policy environment continues to remain very stable with no major tax changes. So there is definitely a predictability for both business as well as investors. And like I said, there is a good amount of sustained focus on infrastructure development, which is road, railways, and defense. Then I think overall, new emerging sectors are definitely finding favor. And while this is being done at the overall sense, what we are sort of getting on the debt side is that we'll continue to see debt to GDP sort of coming down for our economy. So fiscal discipline is something which is not at all compromised. And I think if I have to sort of highlight is that despite a lot of pressure, this budget is definitely not populist. Which is why the total subsidy allocation has been maintained at 1% of the GDP, unlike it used to be about 1.2% in FY26. Then I think the highlight of the budget is the overall government is focusing on driving FDI by proposing a tax holiday for 20 years for foreign cloud companies that are using the Indian data center infrastructure located in India. Now, coming to the key highlights of the budget, So capital expenditure has been the hallmark of this government for a good period of time. I think 10 years back, we had a capital expenditure allocation of about 2 lakh crore. Now this is about 12.2 lakh crore, a growth of 11.5%. This capex to GDP ratio has been sort of maintained at 3.1 odd percent. Last 5 years, we have seen this number growing at about closer to 20 odd percent. So this is the template which the government has been following for a good period of time, and rightly so, because India carries a lot of young population. To sort of create job opportunities for these young population, you need to sort of build physical infrastructure to sort of take the manufacturing leg higher, or make manufacturing contribute more to the GDP. So that has been the template, and this budget is no exception to that. Defense allocation has gone up 17.5 or 17.6 odd percent, largely because of the some deal announcements of which the government has to do. Then the road allocation, which is the highest segment in the overall capex basket, the overall budget for roads have gone up by 8.1 odd percent. Railway is witnessing a far more higher allocation at about 10.3 odd percent. Together, road and railways nearly contribute 50% of this overall capital expenditure. So while capital expenditure is being done, fiscal deficit path is sort of maintained. So this year, government will achieve 4.4%, which is on what they have guided at the beginning of last year's budget. Next year, they are expecting the fiscal deficit to be at 4.3 odd percent. And going forward, this fiscal deficit as a template will be sort of done away with, and debt to GDP ratio, which is a more broader measure, is going to be in the fray. So debt to GDP for FY26 is expected at about 55.6 odd percent, and subsequently by 2030, this number is expected to get closer to about 50 odd percent plus or minus 1 odd percent. Then I think there are some specific announcements. One, buyback was not really sort of, or was charged at a much higher rate. So now this has been made investor friendly, and this is going to be counted as capital gains. I'll come to that. Then, like I said, there is focus on data center ecosystem, healthcare, and some more sectors which I'll come. And since we have already seen announcements on the corporate taxation side long back, personal income tax side a year before, and then GST has been sort of rationalized for a good number of categories. So no major changes is what we have seen on the taxation front. Now, coming to the overall budget math, it's very conservative. That is our assessment. One, because when we look at the nominal GDP is expected to grow at about 10.1 odd percent to somewhere about 393 lakh crore. And just to sort of give a color why we sort of develop that confidence is that, so this year, overall Indian inflation is expected to be about 2 odd percent, but given this low base, next year inflation is expected to be closer to about 4 odd percent. I think whatever consensus we look at, the GDP growth rate is expected to be about 7 odd percent, and with this India-US trade deal, there is a sense that the GDP can further improve by 20 to 30 odd bips. So even if you take 7% kind of a growth plus 4% kind of an inflation, I think you're getting a nominal GDP growth rate of 11 odd percent. Budget is penciling in 10.1 odd percent, so pretty conservative. On the market borrowing side, overall number is about 17.2 lakh crore, slightly higher than what the market was sort of anticipating, but no major challenges there. And on the non-tax revenues, now account for nearly 20% of the revenues. And here, what we are seeing is that the RBI dividend has been sort of playing a bigger role. So this is now really sort of contributing the major chunk of the non-tax revenues for the government. And like I said, debt to GDP is going to be the new metrics which the government is going to follow. And this is expected to sort of slide to somewhere about 50 odd percent by FY31. And so overall, most of your budget numbers are quite conservative, and our sense is that we don't see major challenges in terms of government not being able to achieve these numbers. So definitely, budget math is very much believable. On the capital expenditure front, when we sort of look at the breakup, overall, for example, road has witnessed a growth of 8 odd percent, so about 2.94 lakh crores. Somewhere down the line, railways has been sort of getting a higher chunk because see, the perspective is that railway is a more efficient way of transportation of goods, and if we have to sort of evolve as a manufacturing economy, or the manufacturing leg needs to contribute more, then road and railways, especially railways, has a lot more bigger role to play. Then I think on the defense side, see, while the overall capital expenditure has been sort of going up, there is a good amount to focus also on the indigenization. So of this entire capital budget, I think what is expected is that 75 to 80% is what is going to be utilized by ordering and tendering domestically. So that is another segment which has been the focus. Now, one of the other highlights of the budget is the government announcing that the high-speed railway. So there they have identified 7 routes, which is about 4,000 odd kilometers. And just to sort of give you one context, we are already sort of building a high-speed train network between Mumbai and Ahmedabad, so which is about 500 odd kilometers, and the cost is about 2 lakh crores now. So roughly about 400 kilometers, 400 crores per kilometer. So our sense is that this kind of announcement of new high-speed rail networks on 7 routes could easily entail a capex of about 7 lakh crore. So we would expect some bit of an announcement in terms of detailed project reports getting announced this year, and probably ordering and tendering to sort of happen next week. So we see continuity of this capex even going forward as well. Now, I already highlighted that this budget is definitely not populist because when we look at from the subsidy perspective, 3 major subsidies are there. One is fertilizer. Fertilizer is largely because, or is likely to stay, largely because when we look at this subsidy is provided to farmers. So largely, for example, urea, the farmer pays somewhere about 5.6 rupees per kg for urea, whereas the market cost is somewhere about 40 or even more than, and it fluctuates depending on the input prices or petroleum product prices. So that is one segment which is one of the highest. And then the government offers a free food grain program also to number of rural households. So that also is another chunk. And then the petroleum products, so petrol and diesel largely are sort of deregulated. It is the LPG, which is where the government provides subsidy to some extent. So good part is that the subsidy burden is sort of coming down from 4.3 lakh crore to 4.1 lakh crore. So at this proposed budget for FY27, this number will be 1% of the overall GDP. Then there are other flagship programs like the Mahatma Gandhi National Employment Rural Guarantee Scheme. So that has been renamed. Now, in this process of transition, the government has allocated somewhere about 30,000 odd crores. And what they've also done is that now the procedure has changed. Earlier, the entire allocation which was there was given or was provided by the central government. Now even the states will have their skin in the game, so they will also be allocating a portion of it, and that is how things are going to work. And our sense is that you'll see a lot more effective implementation, because we have seen cases where even 80, 85-year-old is also sort of doing some bit of a work and getting paid for it. So looks unbelievable at times. Then there is a PM or Pradhan Mantri Kisan Samman Nidhi Yojana, which is there. So there the allocation is fixed. So I think There, the government provides about 2,000 rupees in 3 installments to a number of farmers. So these are the flagship schemes where the allocation has been largely maintained. Now, coming to some of the non-tax revenues, one on the disinvestment side, so this year the government is going to miss the revenue estimates for FY26 because not much has happened. There was an expectation that the government will sell one of their primary PSU banks. So I think this will happen next year. So our sense is that in FY27, the government has put an allocation of or is expecting 80,000 crores to be raised from divestment. Now, here our sense is that the government will be selling about 30.5% of the stake in IDBI Bank, which could fetch them somewhere about 30 to 34,000 odd crores. And then on LIC, since it has to remain listed and as part of remaining listed, they need to sort of, or the government needs to reduce the stake over a period of time to take it to 75 odd percent. And currently it's about 95% around. So there also we would see FPOs, stake sale could fetch somewhere about 15 to 20,000 odd crores. So divestment numbers also looks quite believable because now what we have seen till yesterday is that there are two bidders for the stake for IDBI Bank. So FY27 this should get completed. On the RBI dividend front, see the RBI invested in a lot of GSECs globally and even in a big chunk is there with US as well. And our sense is that the US interest rates are still at elevated levels, which is what is helping RBI sort of get a better dividend. And probably while yes, it could lower, but overall sense is that it is still expected to remain at elevated levels compared to what it used to be historical levels. So all these numbers look quite believable and achievable. On the defense side, two, three things I would want to highlight. One, the allocation for aircraft and aero engines have gone up. So from 48,000 odd crores to 72,000 odd crores, largely because our sense is two things. One, we are building a sixth generation aircraft AMCA. So allocation has been, or at least a developmental order of 15,000 crore is expected to be given to some private entities. Then there is a good possibility that we might be concluding the Rafale deal. So probably there could be a payment related to that. So probably the allocation is there. And on the Navy side, I think for Project 75I, which is air independent propulsion system for submarines, I think that is probably going to be signed next week. Next year. So this year the allocation has gone down, and next year the allocation has sort of gone up. Otherwise, I think defense, our sense is that given the geopolitical scenario which has been there for quite some time, I think can't really build a stronger economy without a stronger defense. So I think defense spending is here to stay in India for some time. Now, while the focus has been on the traditional sectors, this budget also recognizes emerging themes and emerging areas where the government intervention is required. One is on the biopharma side. So there the allocation is 10,000 odd crores. And the other is on the semiconductor side, while semiconductor mission 1.0 was quite successful, it was carrying an allocation of 76,000 odd crores. There is an expectation that the government is going to launch ISM 2.0. Then the electronic component manufacturing scheme is going to get further boost. Earlier, the allocation was somewhere about 22,900 odd crores. This has been enhanced to about 40,000 odd crores. So you'll see a lot more electronic components or products being manufactured and with good value addition in India. I think rare earth is a challenge for everyone because China dominates the entire value chain. So that is where I think the government globally or all the big governments are sort of recognizing this as a challenge and looking to sort of address Then on the chemical side, the government is looking to address to tap this opportunity. They're looking to establish 3 dedicated chemical parks. Then capital goods as a sector is has been given due focus also, because one, we need high tech tool rooms. So that is where the government is going to promote manufacturing. For infrastructure projects, tunnel boring machines are a basic requirement, and that is where the manufacturing is going to be promoted. Then there has been shortage of container. At least India has been feeling for quite some time. So about 10,000 odd crore has been given for a container manufacturing scheme. And last but not the least, given the inherent advantage India carries in terms of cotton, so labor-intensive textile sector also has been given due attention. Now, see, the highlight of the budget is the tax holiday for data center capacity creation in India. So currently we are at about 1.3 or 1.5 gigawatt kind of a capacity. And by 2030, this is expected to be in the range of 5 to 8 gigawatt kind of a capacity. Now, what the government is doing is that they are offering 20-year tax holiday for any foreign player who comes in India and delivers foreign cloud services to any global player. And they can offer the same services in India through a authorized reseller, and they get or they have been given enough 20-year kind of a tax holiday, so enough of planning they can sort of do. And while when we talk of data center, it is not the data center which is sort of required. What is also required along with it to support the entire ecosystem is one, you require good amount of real estate. The other is power is a very basic requirement. So we are already sort of doing very well on the renewable energy side in terms of capacity addition on the solar side or the wind side. Now, overall sense is that in the power for base load, what is identified is the nuclear power. So nuclear power has been given due attention, and our sense is that the government is going to pass or is already sort of passed related to private sector participation in the nuclear power. Then I think overall sense is that what it is also going to do is that, see, Indian IT companies are sort of considered as a laggard in this global AI trade, and which is why the IT names or the technology names have been sort of not doing well. Our sense is that a government is looking to sort of change that image with this because for a lot of AI models to sort of run, you need that backend capacity. We are already one of the highest consumers of data. So just to give a perspective, we consume nearly 23% of the global data, whereas data center capacity is only 3 odd percent. So from that perspective, this is another like. And last but not the least, you require good amount of funding. So I think so funding support is also expected, and I'll come to measures what the government has announced. But our sense is that the highlight of this budget is the tax holiday for data center capacity creation in India. Then on the pharmaceutical side, see, we all know that the world is migrating or is in the process of migrating from a chemical drug to a biological drug. And so India can play a good part here in terms of biosimilar. So in biosimilar, government has allocated 10,000 odd crores, and for testing of products, the government is looking at a network of about 1,000 clinical trial sites. And they see the opportunities about $250 billion worth of drugs is expected to sort of expire or go off patent in the next 10 years. And mind you, when you're manufacturing a biologics or biosimilar, typically the cost of a plant is a lot more higher compared to a chemical drug. So which is where I think the opportunity is a lot more there. And this is one segment where a lot of players can't really sort of get in. So I think this is found really favor with the government in terms of announcement. Capital goods is also another sector where a lot of announcements have been mentioned. So a lot of segments, the basic custom duty or duty exemptions have been given to equipment, which is going to fuel this capex. So, for example, battery energy storage systems, or you have other systems, say, for example, biogas blended CNG. So, all of these or nuclear power projects, whatever equipments are used there, all of them have been given duty exemptions. So, I think overall, our sense is that this has been given with the perspective that a lot of US-based companies, or even, for example, we could have Canada as a country which might help in terms of providing the raw material, which is uranium. Capital goods has been also found favor. I already highlighted that you can't really sort of build data center without real estate. So real estate again is a big sector. Real estate was already sort of doing well, and our sense is that with this, the real estate opportunity becomes better. On top of it, the government is talking of the existing government-owned entities also can recycle their real estate by setting up dedicated REITs. And one thing which got announced even yesterday, we had the RBI policy was that now banks or commercial banks are allowed to lend to REITs. Earlier, they were allowed only to sort of lend to infra REITs. So in which so now they'll be able to lend it to REITs. So that is another positive. On the metal and mining front, cement and steel are one of the two biggest, most polluting sectors. Now, to improve their overall ESG score, plus allow by create and also to sort of create an ecosystem where they can manufacture more of green steel with lesser emission. The government has allocated 20,000 odd crores for carbon capture scheme. So that has been the highlight there. And on the auto side, I think rare earth mineral is something the auto industry sort of struggles. So there we have got an allocation, and minor allocation has gone for PLI benefits, which is product incentives for auto sector, especially for EV plus other localization of niche technologies. I already spoke about EMS. The overall allocation has gone up, and I think on the semiconductor side, things are sort of shaping up well. We already have got about 76 odd thousand odd crore kind of investment promised in ISM 1.0, and the government is going to come up with ISM 2.0. The benefits of this obviously will not be visible in the next 1 or 2 years, but probably 2030 and beyond. But we all know that semiconductors are becoming a lot more important and can have implications for economic growth as well. And then I think Jal Jeevan Mission for providing last mile water to sort of households. So there the allocation had gone down to 17,000 odd crores in 2025-26 because a lot of on-ground reports came in that the benefits were not actually reaching to the end consumer or end public. And a lot of issues of corruption were coming up. So allocation got stopped. And now this year we are sensing that, or this year the government has allocated 67,000 odd crores. So my sense is that they've sorted out some of the challenges which they have faced. And on the technology side, what the government is doing is that if the talent can't go to outside, then let the companies come towards closer to talent, and which is why we have GCCs. Now, for GCCs, GCCs provide a different, or global capability centers provide different kind of services. So, for example, if they're providing R&D services to their parent, the overall implications of taxation are different because those services are charged at about 24 odd percent. IT services are somewhere about I think 16 odd percent. So government is now saying that they will going to levy a uniform 15.5 safe harbor margin kind of a rule. And this threshold limit has also been enhanced from 3,000 to 2,000 odd crores. So I think GCCs is something which is what the government is looking to promote going forward as well. And on the BFSI side, after a long period of time, at least I heard FM or finance minister mentioning NBFCs. So what we're clearly sort of sensing is that uh, uh, NBFCs like power finance and rural electrification are expected to be merged. On top of it, there'll be some more PSUs which will get merged. So overall perspective is that if you have to create a data center capacity, I think what we have already got commitment is somewhere about 70 odd billion dollars, and expected that it will go up to about $200 billion. Now, this will require a good amount of financing. So you need to create NBFCs for that, and which is what the announcement and the budget was. So that was another thing which has sort of come up in the budget. On the logistics side, I think overall one, there was a container manufacturing announcement of and allocation of 10,000 crore, which was there. And I think overall budget was very constructive from a longish growth perspective. I think what was really not liked in the budget was two things. One, there was no major announcement for FPIs. Then the second was the STT on futures and options were raised. Now, we all know that in the last few months or last 15 odd months, we have seen FPIs selling. Last 1 year, they've sold somewhere about 17 odd billion dollars. Now, overall, there was an expectation that some measure would come, but the government did not announce any kind of a measure. And I think this tax holiday on data centers. So clearly, what it is sort of signaling is, or the signal which we pick up from the government is that they want more FDIs to sort of come in and not really willing to give to this pressure of short-term money coming into the markets and going. Besides that, the STT was hiked on futures and option because the government believes that, and it's a fact that a lot of small investors lose good amount of money in futures and options. So, which is why the STT has been raised there. And it's not an exercise to sort of raise the revenues. It is an exercise to sort of curb the excessive thing or speculation which was going. So that was the only negative which was not really liked by the markets, and which is why market had corrected. One more positive development in the budget was the buyback regulation. Now, earlier, if a company used to undertake a buyback, say hypothetically Infosys, if an investor is getting the money, so what happens is that in that process, whatever amount is there, it is treated as dividend. So if an investor is falling in the highest tax bracket, then it used to be sort of clubbed with their income, and that is how the taxation used to happen. Now, this will be on par with a long-term gain or a short-term gain. So it is now in par with the taxation for capital gains, be it short-term or be it long-term. And which means that the taxation will come down to 12.5% if the stock is held for more than a year, and if it is less than a year, it's about 20 odd percent. And for corporates and promoter also, it is lower at 22 and 30 odd percent. So sum total budget was very constructive for laying the foundation for structural growth, and which is what we have been experiencing for a good period of time. Gone are the days when we used to have double digit or closer to double digit kind of inflation. Inflation is pretty stable, and which is why even the economic growth is very stable. And I think this budget is a step in that direction. Another important event which happened was the India-US trade deal. This was the much-awaited deal. Not to say that it has got implications from a P&L perspective, because when we look at top 500 companies, since India is not a major export economy, so overall numbers-wise, it does not impact, but it does impact indirectly. One, the biggest segment in India is BFSI. In BFSI, obviously, we have seen a good amount of FPI selling. So obviously, the banking segment gets impacted, or the technology gets impacted. Sentiment also gets impacted in the small cap segment. So which is why, from a sentiment perspective, this is definitely a lot more positive. I think this has been going on for a good period of time. And with 18% kind of a tariff, our sense is that we are going to be a lot more competitive there. Definitely, I think this is a step in the right direction and much awaited deal. And we have already seen initial signs of foreign portfolio investors turning positive on the Indian markets. Let's see how things sort of pan out going forward. But this is definitely a positive one. Now, coming to specific sectors, I think see the biggest positive is for a sector or labor-intensive sector like textile, because what is happening is that US is somewhere about $100 billion kind of a market, and India has got about 80% kind of a share. And with a tariff as high as 50%, the exporters were at a disadvantage. Now they will be able to sort of capture that or recoup the market share. Now, what is also happening is that sometime back we also had a deal with India EU. Now, there, the overall textile market is somewhere about closer to $200 billion, and India's share is about 3 odd percent. So, our sense is that when this deal becomes effective in course of time, this share can easily go up because earlier Indian textile exporters were at a slight disadvantage compared to a lot of other competing geographies like Bangladesh, Pakistan, and others, including China. So Vietnam. So from that perspective, I think textile is something we believe that some months down the line or some quarter down the line, it is very much possible that a lot of these players or companies might look for capacity expansion. So that is definitely positive. On the EMS side, although most of the segments were sort of not impacted, but our sense is that the overall deal announcements will sort of pick up, and which is why capex overall can pick up in this particular segment. On the automobile side, so the decline in the reciprocal tariff to 18 odd percent is definitely positive for ancillary space more than the OEMs because we typically don't export much of the overall vehicles. So what we export is more of parts, auto parts, and this is positive for CV segment because on the PV side, there is a separate category where the tariff rate is 25%, and it's not only for India, a lot of other economies pay that kind of a tariff. On the capital goods space side, I think overall sense is that whatever we have seen in terms of reduction in the budget is done with the perspective of a potential deal with US, which is what has happened now. So a lot of technology engagements can happen in crucial sectors like say, nuclear power and the others. Then chemical is another sector or segment which will benefit because India does export about $6 odd billion, which is about 18% of the overall chemical exports. Now, the challenge here is that China has been sort of dumping a lot of categories, so the pricing and the volumes were depressed, and which is where I think things can sort of improve going forward. So that's all I have to say on this two events. Our sense is that this last 7 days has been pretty crucial for the markets. One, I think from the budget perspective, we are not giving into the pressure of short-term relief. Structurally, the economy is sort of shaping up very well. After a long period of time, we are seeing that the capital expenditure is inching closer to the overall borrowings, which means that whatever borrowing is being done is done to sort of support the capital expenditure. Then I think the India-US trade deal is definitely a big positive from a sentiment perspective in terms of foreign inflows. It can probably arrest the decline in the currency, and which is what we have already seen in this last week. So sum total, I think things are shaping up very well for our markets and for our economy. That's all I have to say. Thank you so much. I'll be more than happy to sort of take questions.
Excellent. Thank you so much, Pankaj sir, for this insightful presentation. I'm sure that this initiative provides numerous opportunities for the NRIs to gain a comprehensive understanding of India's economic growth story. Now we'll move to our last session, which is the Q&A session for the evening, where we've received a couple of questions, and we'll try and cover some of the most relevant ones, in paucity of time. Now, The first question, sir, is what are the key union budget announcements that directly impact NRIs this year?
So I think broadly, Anish, if I have to sort of put there are 4, 5 things. One, there is a ease of compliance for NRIs. Then there is announcement on the voluntary foreign asset disclosure. Then there is an effort being made to reduce the litigation. Then I think decriminalization of technical defaults. And I think one more thing is smoother cross-border transactions. So these are the areas which on which the budget has focused on.
Okay, got it. So the next question, sir, is does the budget signal any long-term policy direction that NRIs should factor into their India investment strategy?
So I think for NRIs, returning Indians or global professionals, I think this budget addresses some of the key pain points. One is foreign asset disclosure. Then there is a revision or the updation of IT returns. Then black money exposure and disclosure details for NRIs. Then I think one of the other big announcement was the sale of property in India by NRIs. Now, just to sort of highlight here, earlier, if an NRI used to sort of or wishes to sort of sell a property, the buyer, if he's residing in India, they had to sort of take the tax deduction and collection account number. So separately, they used to take for this. They used to sort of apply, and then they used to sort of deduct TDS. Now, what is being done is that now all these transactions can be treated the way it happens in within India. So this TDS payment can happen through PAN number, and I think so you can sort of generate challan. So and this is going to be effective from 1st of October 2026. So yes, life is becoming simpler for NRIs, especially to some of the announcements what we've seen in the budget.
Okay, great. So the next question is, what immediate actions, if any, should NRIs take to stay compliant and tax efficient post-budget?
So Anish, I'll highlight some of the things. So one on the so there has been extension of timeline for revisiting or for revising and sort of filing of the income tax return. So earlier this timeline was till 31st December. Now that is revised to 31st March. Then there is a revision after or revision after December is also allowed with a nominal fee is what is required to be paid. That is one. Then there has been staggering of the ITR due dates. So for individuals, which is ITR 1 and ITR 2, I think the dates are up till 31st July. And for businesses and say others, or for say, for example, trust, this is up till about I think 21st of August. So that has been the. Then I think for updated returns, or if someone is updating their returns, then they can file. So if there is a reassessment sort of going on, they can file the re-updated returns by paying a nominal additional tax of 10 odd %. So from that perspective, the challenges are going to be a lot more lesser. And I think overall, what this helps is that in case if an NRI has missed foreign income disclosure, or if there is a capital gain which they have missed sort of disclosing, so a lot of these things is what they can sort of utilize or take the help of, or the process becomes a lot more less cumbersome for them to sort of comply. I think these are some of the points which is coming to the top of my mind.
Perfect, sir. Thank you so much. So, sir, before we take the last two questions for the day, I will request all my viewers to please, give us your feedback. There'll be a link which will be shown on your screens now. Please take a minute and give us your feedback so that we can plan our webinars more better and give more insightful sessions for you. So, the next question, Pankaj sir, is how does the budget address repatriation rules or limits for NRIs and overseas investors?
So I think one of the other announcements which is there, which I would want to highlight is, or which I would say is one of the most important one is that concerning investments by NRIs or overseas citizens. So earlier, an individual or overseas citizen, if they were to sort of invest in a company, the maximum allowed was 5%. Now this has been raised to 10 odd percent. And also, if there is a group of individuals which are there, earlier the limit was 10%. Now this has been raised to 24 odd percent. So I think overall, the messaging which we get from the budget is very clear that the government is looking to sort of welcome long-term money rather than sort of chasing short-term money, which might sort of bring relief. So that is the key messaging which we take, and which is why some of these announcements are with respect to that, especially for NRIs.
Okay. So, sir, we'll take the last question now, which is what sectors or asset classes look most attractive for NRI investments after the budget announcements?
So in terms of asset classes, see, gold and silver are sort of very volatile, not the best of the times to sort of chase gold and silver, given the inherent volatility. While yes, volatility can remain at elevated levels, but I think very few investors will have the kind of appetite to digest this kind of a volatility. I think equities last 12 to 15 odd months haven't done much in terms of price performance. And I think there were two, three concerns. One, the valuations were higher. So last 1.5 years, we have seen an earning growth of more than 8 odd percent. So that has addressed the rich multiples to some extent. And I think whatever concerns have been there, we have seen price correction also in the market. And so overall sense is that from here on, you will see about double-digit kind of a growth. Now, with that in perspective, I think some sectors which are looking relatively attractive to us is one, obviously, capital expenditure related sector. So it could be capital goods, which is there. Power is becoming a core for energy security for not only for India, for across economies. And in power, the entire value chain looks good. Now we are adding, or we would be looking to add nuclear power to that. So power is becoming a core sector going forward. And a lot of problems in power has been sort of sorted out in the last few years. And I think one more sector, if I have to sort of highlight, is the banking and financial services. Indian banks and NBFCs are in the best of the health of what we have seen in the last 10, 15 odd years. Last 1 year, we have seen RBI cutting rates by 125 bips. So as a result of that, the lending rates come down first and the deposit repricing happens with a certain lag, which means that the margins for banks and NBFCs had sort of come down. And while our sense is that this will get sort of corrected, so it's a sort of a technical issue. So next year onwards, even a big sector like banking and financial services will start witnessing a healthy double-digit kind of a growth. So earnings are also expected to sort of pick up there. So I think these are some of the sectors, so which is capital goods. And in capital goods, again, you will have a number of sub-segments. Besides that, cement and steel are core sectors. Power is another, and BFSI is another segment which is expected to sort of do very well. So these are the sectors which we feel are structurally shaping up very well. One more sector, if I have to add, is the pharmaceutical. I think the way people are messing up with their lifestyle, pharmaceutical or healthcare as a system or as a sector is expected to remain very much relevant, not only now, even a few years down the line. So So that way, I think that is another sector.
Excellent, sir. Thank you so much for giving us your time and taking us through the budget and answering all our questions. So with this, we come to an end of the session. Thank you very much for being with us today, and we look forward to seeing you again in the next webinar. Till then, stay safe and bank with us. Thank you.
Thank you so much.